Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. One of the biggest reasons property investors stall isn't the market, isn't interest rates or regulation, it's vague goals. I want more properties. I want better cash flow. I want to scale this year. They sound good, but they don't drive decisions. Without clear objectives, investors drift, chase shiny deals, and look busy without making meaningful progress. In this episode, I'm going to break down how to use smart objectives specifically for property investing, so instead of wishful thinking, you have clear, measurable targets to shape your finance, your strategy, and your decisions throughout the year. Let's jump into it. So welcome back to the latest episode, and as I mentioned, we're looking at smart objectives. I think Mark and I discussed at length plans for the year ahead regarding mindset, strategy and goals. And one of the things we talked about was smart objectives, and I just thought it would just take a short time just to explain that in a bit more detail and what that looks like. So hopefully this is helpful. So what does smart actually mean? So smart analogy or context is goals which are specific. So S is for specific, exactly what you're trying to achieve. M is for measurable, how you'll track your progress towards achieving that goal. Achievable, is it actually realistic within your current constraints, your timeframes, your experience, funding, etc.? Is it relevant? Is it aligned to your long-term strategy, which is obviously something we talked about in the last episode? And is it time-bound, something that's got clear deadlines? So, yeah, smart goals don't limit your ambition. They actually help to focus it and spend your time doing the things you need to do to move yourself forward. So just want to break that down a little bit more now to help you if you're a property investor and just give you some examples of where this may be helpful. So we'll start with specific. What are you trying to achieve? And I think I mentioned this previously, is around a bad goal is I want to grow my portfolio, or I want to increase my portfolio, etc. It's fluffy. It's got nothing. There's no context to it. So it's not specific enough. So a smarter version of that would be, I want to purchase one semi-commercial property with a minimum 7% yield. So it's very clear on the type of property and the minimum yield. So you're trying to bring in some structure and clarity around what your deal looks like. So this is almost like an elevator pitch for the types of deals. And you could take that a little bit further in X location with a maximum property value or maximum purchase price. So you can add layers onto that sentence and just be more specific about what it is. So things are like property type. So is it buy to let? Is it HMO? Is it serviced accommodation? Is it commercial, semi-commercial, blocks of flats, etc.? So what type of property is it? If it's residential, you can go, well, I want to buy residential properties. You may want to focus on bungalows. You may want to focus on terrace properties. You may want to focus on flats, So what is your property type? Mentioned location is another one that you can add to that. So where is your gold mine area? In some people I know will just purely work in a very specific square mile, or a lot smarter within certain streets even. And they know that if anything comes in up in those streets, they're on it, and they know what they can pay because they know they've got the due diligence, they know the numbers, and so that helps. Are you an area of where are you chasing yield or are you chasing capital growth? Depending on what is your strategy. So you can be specific around that. And then ownership structure as well. Are you buying it in personally, or are you buying a limited company, for instance? Okay, so that's being specific about what you're trying to achieve. Moving on to measurable. What does success look like? So again, if we just want, if we use an example of a bad goal would be, like I mentioned earlier, I want better cash flow. Well, if you're looking for cash flow, a good, smarter version of that would be, I want £1,500 a month in net cash flow after finance and costs. So all of a sudden it's becoming a lot clearer. You could add tax to that if you wanted to, so after or before tax. So it just becomes a lot more clearer to measure what success looks like. So that can be various different things you can consider here are monthly net cash flow, which I just mentioned. Talk about loan to value. What are you playing at the 75%, or are you looking to be lower risk tolerance? Are you looking for portfolio value? So maybe cash flow is less important. You might just be buying for capital growth, in which case the portfolio value is more important because you'll get more growth on that portfolio over time. It could be a number of properties. So by having, more properties, you reduce your risk. You got eggs in more than one basket effectively. So you might have one property that's unencumbered, or you could have 4 properties with mortgages on. So you're spreading the risk across those, but you're increasing your debt. So just different things to consider. One of your measurables might be reducing your debt. You might have some private finance, you might have some bridging, you might have some mortgages on high rates that you want to refinance, and just, it's not always about getting more, it's about restructuring and how can you be more efficient with what you've already got. So that's some of the things you can measure. Moving on to achievable, what can you actually finance, and is it possible? So things like lending limits, are you mortgageable if you're looking for mortgages? How much cash do you have? Do you have money available for deposits? If you don't, then that's a problem and you need to find money from elsewhere, in which case you might need to build an investor pool and go out and build a campaign around speaking to investors. Stress testing your deals. Do they work for the values that the properties that you're looking for? Do the stress tests work? Do you know what the stress tests are in order to stack the deal? Your tax position. If it's personal, are you a lower taxpayer or a higher taxpayer? If it's in a company, it doesn't matter so much, but there's different taxation on that. And then time and energy constraints. So one of the things people talk about a lot is money, but actually, I think more importantly is time and energy. So where we can spend, how much time have you got to build a portfolio? Is it, if you're super busy already and you don't have any time, then you need to maybe find someone to work with. And how much energy have you got? You might be in a really high pressure job and you might have a big family and lots of other things going on, and you might not have the energy to throw into it. So really take stock of where you're at and what you can put into it. So an example of what's achievable. So, buying 3 properties sounds great, but if you've only got the deposit to support one purchase, then that goal isn't achievable right now. So what do you need to do to make it so that you can buy 3 properties? Do you change your time frame? Do you change the goal? So what is actually achievable? Because you don't want to say, I want to buy 5 properties at the end of the year, and it was never achievable in the first place, because then you'll be downhearted, downbeat about what you've actually achieved when you get to the end of the year and review how you've gone. Relevant. So does this sort of move, or does your strategy and your goals and your objectives move you closer to the life that you want? So one of the things we talk about is not every deal is a good deal. We get asked all the time, is this a good deal? And what is a good deal for me is a good deal for you, is a good deal for the next person. They're all different things. And this way, you having clarity on your criteria and your deal stack is super important, and having that clarity and confidence in knowing which deals to go for and which not to. So things to consider really is, does the deal align with your risk tolerance? If it's really risky, then, maybe not. It just depends on your risk tolerance. So we won't talk too much about is it risky or not, because that's down to your tolerance and that's your deal stack. Does it suit your time availability? Is it building towards your longer term exit and plan? Are you buying assets, or are you creating more workload and more admin? So things to think about here are, for instance, if you are looking for passive income, yet your strategy is chasing HMOs and serviced accommodation, then I'd argue that isn't really relevant or aligned, because HMOs especially if you're self-managing and serviced accommodation, where there's changeovers and cleaners and bookings and everything else. That's very busy and noisy and absolutely not passive. And then the flip side of that, if you're trying to build an income to leave your job, to go full-time in property, for instance, then buying single buy-to-lets with low cash flow is probably not the way to do it either if you want to get there quickly. So then maybe chasing HMOs and serviced accommodation may be the better route for you. So just trying to think and really drill down into the detail of what's relevant. And then finally, time bound. When will this happen? At some point this year. Again, too fluffy. A smarter version of that would be by September, I have completed on one property and refinanced an existing asset. So really clear on what you're going to do under what timeline. And then just things to bear in mind when it comes to time things. I think deals always take longer than expected. Very rarely do we have deals happen quicker than people had planned. Always they take longer. There's so many moving parts in every part of the process. With third parties, you've got underwriters, you've got valuers, you've got solicitors, you've got brokers, you've got lenders. There's so many different parts. Plus then once you've got it, you've got builders and subcontractors and utility companies and water companies and so many various things. So there's always something that takes longer than expected. And then finance timelines, like I mentioned, lenders, solicitors, valuers, all of those things add to the process. So just taking the time to plan up front will save a lot of time in being urgent and reacting at the last minute. So just some kind of key takeaways really that just be mindful of. So setting goals without checking the finance feasibility and whether you can actually do what you're trying to do. Being overly optimistic on timelines. Like I said in the previous episode, we overestimate what we can do in 1 year, but we underestimate what we can do in 5. Ignoring tax and regulation impacts on the bottom line. Copying someone else's goals. So, yes, use what other people have done and what they've achieved as motivation, but don't use it for comparison or copying their goals because everyone's different. And then finally, confusing activity with progress. So just because you're busy doesn't mean you're busy doing the right things. So just a couple of examples then to wrap up is, if you're a beginner and you're a beginner investor and you're first time and maybe you don't have the cash, well, maybe the first thing you want to do is just set aside the savings goal to buy your first deposit. So you might say, I want to save £25,000 by December for my first buy-to-let deposit. Nice, clear, actionable, realistic, relevant, and very time-bound. If you're a portfolio landlord already, then you might say, well, I want to refinance 2 of my properties by October to release another £100,000 for reinvestment to grow the portfolio. And then if you're an experienced investor, you might say something like, acquire 1 more semi-commercial asset with a 10-year lease by Q4 in this location with this yield. So very clear, very specific, and very time-bound. So hopefully that's been helpful. If you've got any questions about these or have got anything that you'd like to discuss, then get in touch and we'll see how we can help. Thanks for listening. If you're setting goals for the year ahead, start with clarity and not ambition alone. Smart objectives force you to think about the finance, the risk, and strategy before you act, which is exactly how successful investors move forward with confidence. And if you want to help stress test your objectives, seeing what's realistic, what's fundable, and what strategy fits you, that's where we come in. Speak to us at Prime Property Finance before you commit, and we'll help turn your goals into a plan that actually works. Thanks for listening, and we'll see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.